Hello folks, this is ICT with a tutorial on the ICT swing trading model, and we will be incorporating institutional order flow with this teaching module. Now, I know some of you have in the past seen my previous material as it relates to swing trading, and it's pretty generic, um, pretty um, basic in terms of what many of you probably would have expected, but I think with this specific tutorial, it'll help streamline a majority of the things that you were unable to divulge from my earlier works. You'll be able to uh, draw a stark contrast to what was missing from the original teaching and what is available now with the understanding that's been shared through the ICT Sniper Series video course and the Precision Trading course. Um, and obviously the earlier works in this present Market Maker collection series. We're going to be looking at specifics on how I go into the marketplace, how I go in looking for specific setups based on swing trading mentality. And we're going to give you the actual step-by-step procedure that I employ when I break down the marketplace. It always begins with a top-down analysis, and I used the tools that you've already been accustomed to, but I do it in such a way that it's very methodical, it's very systematic. It doesn't deviate, it's not ambiguous, it's very clear, and it's not a lot. It's not a lot of information at all to you know go through to determine a trade decision, whether you should be taking it a long, a short, or just standing on your sidelines and just waiting for a new opportunity. The the main takeaway from this module, I think, is going to be the fact that when we go into the higher time frames, what are we looking for on the higher time frame? How do we break that down and use it going forward? And some of it will seem very similar to some of the earlier works that I've shown, but the main intention is to draw all of the previous uh, insights and make them into a very methodical approach to going into the marketplace, studying price action, and no fundamental data, no indicator-based decision making, just purely looking at price action alone, higher time frames, top down, moving into a lower time frame. Now, when I say lower time frame, we're only going to be really specifically dealing with 1 hour setups. Okay, but it's going to be hinged and framed around what takes place on the daily and weekly chart. Okay, so without further ado, let's get on with this particular trading module on ICT swing trading. Okay, folks, we are looking at a ICT workspace. This is an idea that I suggest you employ with your analysis. And it's something that you've seen a couple times in my earlier works, but I just realized it's a lot easier to streamline the teachings and review videos working with just one chart and just moving between the time frames on one chart. But as you're developing and learning the concepts that I'm sharing in your demo account, the idea is to kind of like have this mindset in front of you. Okay, and I've been doing it for a lot longer than the majority of you that are watching, and because they're my tools and it's my approach, I'm very familiar with it, and I can move in and out of time frames with the understanding of what it is I'm specifically looking for, and not lose sight or lose track of the higher time frame analysis principle that we're going to be really focusing on to facilitate swing trading. The the larger chart on the right hand side, as you see here, we're going to be predominantly working with the 1 hour chart for setups. Okay, and it's going to be framed on the idea of what is seen on the lower left hand chart here, which is in this case the daily. Now, the rules for swing trading as it relates to ICT, I like to go 2 time periods higher than my executionable time frame. For instance, if I'm trading on an hourly basis or looking for setups on an hourly chart, okay, I need to have the higher time frame analysis influence arrived at from not the 4 hour chart, which would be one step above the 1 hour chart. I'm looking at the daily chart, okay, and then above it is obviously the weekly chart, and then you see that up here in the upper left hand corner. How big you scale these to is your matter of your personal preference, okay? But as long as you have the ideal uh, scenario of having all of the time frames in front of you, especially when you're first learning, because if you don't have this in mind, you can look over here in this chart here, and what you see a lot of times in my reviews is we'll have one time frame, and I'm only talking about this, okay? But unfortunately, a lot of times I make it seem so easy that I can see everything just on that one time frame. I've already did my analysis on the higher time frames and worked my way down into that time frame many times you see in the review. And the review is really that it's reviewing price action. I'm not teaching my trading concepts because if you go through the tutorials, that's the part or point, if you will, of the tutorials. Okay, so there's a difference. Okay, sometimes in my reviews I do a little bit of teaching, but as it relates to real hardcore analysis, you need to be going through the process of top down as we're discussing here. So now, if we're looking at the idea of trading on 1 hour setups, okay, how do we arrive at those setups based on a weekly and daily time frame? Well, the first thing is we'd like to look at the dollar index because as it relates to Forex, the dollar is king, okay, and price action is king. So when we go into analysis, we have to first arrive at what we expect the dollar to do. Is the dollar bullish? Is the dollar neutral? Or is the dollar bearish? Those are your three choices to arrive at in your analysis. Based on that analysis, it gives you every aspect of trading foreign exchange that you would ever need. Okay, it's very simple. If the dollar index is bullish, we would be looking primarily for shorting opportunities in foreign currencies. If the dollar is bearish, we would primarily be looking for bullish conditions in foreign currencies. So it's very simple. If the conditions in the dollar index are a little muddy, or we just really can't arrive at a trade idea based on the dollar index, that would basically mean that you're neutral on the dollar. So that means you either stand on the sidelines or don't swing trade. Go down to a smaller time frame for doing something like scalping or intraday day trading. Okay, so have that in your notes. If we ever arrive at the higher time frame analysis principles that we're discussing here, if it's a little unclear as to what it is most likely going to be doing, drop down into a lower time frame and just primarily work in those short time frames. Okay, and we'll talk more about that as it relates to short-term trading and day trading in the later modules in this series. Now, originally I had material for this module, and I elected to change some things and omit some others because it will probably be more apt to see it better explained in the day trading uh, module in this series. And don't be afraid that I'm taking everything away and not teaching you everything. Everything that I'm willing to share is what I'm sharing. Okay, so when this series is done, don't ask me for anything else that may have not been shared, because if it's not here, you're not getting it. So there you go. You can have wild success for the principles that I've shared thus far. Even if I don't do this video and never do any more, you've learned more than majority of everyone else that's teaching in the circuits in foreign exchange or trading in general. But I want you to start with a weekly chart. Okay, and upper left hand corner, what you'll do is just you'll maximize that chart, and this is what you generally see when you see my analysis. It's in one chart perspective, and I never minimize my charts to show you the overlay of how I'm viewing the marketplace. Okay, but this is generally what you're not seeing. What I do is I try to get as maximum perspective as I possibly can on the higher time frame. Okay, and we talked about during this time period here being bullish on the dollar index, and we've been bullish all through here. Okay, and in fact, I was calling for 105 in that area as longer term objectives should the dollar continue its move higher. And at the time of this recording, I'm just putting that in there just in case there's ever a question. If we do trade to that point, one more marker as it relates to prognostication and looking for potentially further advancement in the dollar. Now, I think if we get to 105, I think we're in trouble for the dollar. I think it'll be a pretty massive sell-off from that point. I don't think it's going to maintain those levels if it gets there at all. But that's outside the scope of this teaching. I just want to bring that up, just as a discussion for you to ponder on your own time and decide whether or not there is any merit to that idea. But when we are looking at weekly charts, what we like to do is we like to have major support and resistance levels noted, and that's just classic highs and lows. We have here, we have this high here, okay, and we have a swing high in here. And by having these levels noted on these charts, especially the weekly chart, it gives us a broad brush idea of where the institutions, because that's who pushes price around on a grand scale, not minor little fluctuations. But when we see price trading like this at this low right here, okay, and we've created a high here, what will happen is we'll have all of the intermediate term price swings noted on a higher time frame weekly chart. Okay, and then from here all we have to do is drop back down into our little smaller scale, and we'll have these levels in mind, and we just zoom in to keep those levels in the forefront of our mind. So we'll see that in price action as we work through the daily and 1 hour charts as price moves through. Now when we have them on a higher time frame like this, we don't necessarily have to have every one of these levels drawn on our executable time frame like the hourly, because as price trades to it over here, when we look at it in this overlay perspective, okay, when price is trading like it is right here, okay, this same price is shown the same as it's seen over here, okay, 95.46, that's the closing price here, 95.46. Okay, same thing down here, 95.46. We don't need to see all these levels on every single, I'm sorry, we don't need to see every single level on our executable time frame, because if you have this overview worksheet or workspace idea, it'll keep your charts very clean and crisp. Okay, and then as we trade to these levels, okay, on the higher time frames, we'll be able to see and ascertain whether or not we should be expecting bearishness, a pause if it's been advancing, or an all-around reversal. Okay, so the same thing we did in the weekly chart, we'll do on the daily chart here. So we just maximize that chart as well. Okay, and some of the levels that would not be seen on the weekly chart, okay, we have a lot more detail in here. So we would just go through and identify levels that are useful. Okay, so we have these two levels in here. Okay, we already noted this on the weekly chart. So these levels I'm trying to keep distinct to specifically the daily chart. And we have one more that I would have in mind, and that's this little period right here as we're maintaining some resistance, old resistance here. So if we have these levels now on our chart, we minimize it rather. Okay, so we have these levels. Now, some of the traders that I have mentored over the years have tried to apply every conceivable support or resistance level at their disposal, and they'll have their charts completely inundated with all kinds of levels, and you don't need to do that. Okay, but as we trade, like for instance right now we're trading at this particular level of interest. Okay, now we're not looking at order blocks, we're not doing anything of that capacity yet, but we're just looking at primarily levels that are of potentially influence of current price action. So right now we're trading in between the range of 95.65 and between the 95 big figure. Okay, so basically a 65-70 pip range essentially is where we're at in the dollar index. Okay, looking at the daily chart, okay, we have this level here, 95.67 or thereabouts, and it doesn't have to be specific. Okay, it doesn't have to be so precise on these higher time frames, because we'll be able to see it fine-tuned on the lower time frames over here. But as we're trading right now, okay, the only two levels well, actually three levels would be of any major interest in terms of support resistance would be the 95.67, 96.89, and 93.55 basis on the daily chart. Okay, so now we'll take those levels and they'll be the chart time frame, reference points for our executable time frame. Okay, so we're going to put 93.55 down here. Okay, and the low here is 93.58, so that's the level actually we're going to be using. And that's this level right here, that's that low. So this low is exactly happening right there. Okay, the high on this candle comes in at 95.67, so we're going to put our level 95.67 right there, and that's our high right there. And we just recently went through it, tiny little pip or two above it, and the high is 95.69, seen here. So we will now adjust that to show the highest high. Okay, so now the only higher level above that will be 96.89, and we'll just scrunch our chart up a little bit. A little bit more. Okay, so that level will be resting on our chart should we trade up to that point. Now, where we're at in terms of our executable time frame, 1 hour chart, okay, we can clearly see there are support resistance levels that we would be considering, okay, and that is seen by way of using a short little trend line in contrast to the horizontal support levels that we noted with the full horizontal levels. That just delineates in our mind that these levels are coming from a higher time frame, so they're going to have a whole lot more influence. Okay, this level here is going to be one I would watch because it's basically an old high here, almost a low here, and also is in the middle of this liquidity void here. So we had a real quick run up. There should be an interest of eventually filling this. I'm not suggesting it's going to happen right now, but as we see price, if it starts to break down, we would expect to see price come back down into there and then fill into this little order block as a downside objective. But for now, what we do is we look at our higher time frames again, and we go through and see where our order blocks are. We recently, off a weekly basis, rallied up rather sharply and then retraced back down into the down candle, which is the bullish order block. Okay, and we've since seen a bounce in that area. Okay, so inside this down candle, we would expect to see some level of bullishness or a bounce. Okay, and we see that happening with more detail right here. So this bounce here up is this right here on the daily chart, and then we came back all the way down here to fill in to an order block here, and then we saw that rally up. If we go into our executable time frame, maximize it, 1 hour time frame, and scrunch that down a little bit. Okay, this is that rally up, and we've now retraced back down into it. This level on here, okay, this level, we're going to go over here and zoom in, and we're going to look at the all this consolidation in here. Okay, if we look at this, we're going to use the tool of institutional pricing, where we use a consolidation or range, okay, like we have here. We can add our fib to it, and what we're looking for is the midpoint or fair value, or what was commonly referred to in our teachings as equilibrium. Okay, see that? The 50 level is exactly right there on our level, so that's a good level to have in terms of fair value, equilibrium, and higher time frame order blocks and support resistance levels. So price comes out of this area, sells off, and once it comes down into that level right there, boom, we would expect to see price rally. When price rallies like this, okay, what we do is we expect to see price take out a swing high. This is important because we're swing trading now, so we are trying to get in sync with the next price leg or price swing. The bounce here is what we expect to see. Now notice this little short-term high in here does not get broken here. Doesn't get violated yet. Only until this candle here do we see this high being broken. And that's exactly when you would expect or anticipate rather the market structure shifting to bullish right there on this candle. Okay, so when that happens, we go back to the beginning of the move going up. Okay, based on this on the short I'm sorry on the support line. So this support line here, all we do is go and look for the down candle prior to the move up. So let's zoom in a little bit here. Right here. Now we have a little candle in here, but this little candle is inside of the body of the larger down candle prior to the move up. So this is an up candle, this is an up candle. Okay, we have a little small little body down candle here, but again, we're going to be looking for the big beefy, most bold bodied candle prior to the move up. Okay, and that's going to be this one right here. So if you go back through the precision trading concepts and sniper series, and when we're talking about order blocks, you'll see that this is the candle we will be using, not these little tiny things here, because these are already inside of the larger bodied candle. Okay, so now what we do is we are going to borrow this level here because we understand we've broken market structure on this candle, right? Well, actually it's this one here, but nonetheless you can see it's been broken. We use the high right here to the open of the candle, so that the high of the wick down to the body, that's the range in which we anticipate the most sensitivity. Now it can trade as deep as 50% of the body's candle and still be valid. In fact, it can trade all the way down to the low of the candle, but we don't like to see that. The highest probability in terms of buying in bullish order blocks or down candles prior to big moves is they're going to be basically protected about midway point of the body of the candle. Okay, so if you draw a fib from the high down to the low, wherever that 50% level is, have that in mind. If it gets to that level, it's probably unlikely that you're going to see a very sharp rally away from it. Generally what you'll see is the high or the opening price on the down candle is going to be the sensitive levels at which you would expect to see price move from. So here's the reaction on just using the high, and this is the reaction seen with using the low, the opening of that candle right there. And we've only dipped, well, this level here comes in at 93.88, and the low on this candle 93.83. So we're only talking about 5 pips difference. Okay, so it allows you to keep your entry levels very close to the market, where you would expect very little drawdown. So that's the wonderful thing about the precise nature of our concepts. Going back to this area over here, if you're having a big candle like this and you notice there's small down candles or potential what would be viewed as order blocks inside there, and they have wicks above it, okay, you can use the idea of potentially reaching as deep as the opening on this candle here and filling in this wick. Okay, but it doesn't do it here, but it very well could have done it and been very precise at this opening of this down candle here. So that would have been something that you could have been looking for, anticipating. Okay, but primarily if you just look at the open and the high on the down candle, that's where you're going to be looking at for your entry point, okay, or expected bullishness. So now when we see price come off of this level here, this is where, right in here, that's where we would anticipate right here, this is where we'd anticipate a bounce or a bullish entry. Okay, we would expect bullishness to come underway in terms of the dollar index. Now when this happens, okay, what we're doing is we have a green light go to start looking for swing setups. Okay, now if you're bullish on the dollar, what we're going to be doing is we'll look at the overall price structure here, okay, and we look at where we're at in terms of the ranges. Okay, and what I mean by that is typically you've seen in the past, especially in my earlier works, you would see this. This is where I would say this is our optimal trend entry, and we would be getting long around that sweet spot, which is where we went down into, and then it rallies off again. If you miss this and we have this big rally up, it creates a liquidity void. Price will come back down and fill in that gap. You can take the fib right here from the low up to the high right here, and you'll get 79% retracement level in here, back to an order block, and rallies off again. That's what you saw in earlier works as it relates to ICT in my teachings. What I want you to primarily focus on now is the swings in which price moves. Okay, we've identified a level on the higher time frame we would expect to see bullishness. Do we trade right there? We can, but you want to see the highest probability setups, probable rather, setups in your trading. This is what you do. You wait for the move away from it, and this exercises rather the central tenet to consistency in trading, which is patience. When we see the level down here, what we anticipate is the move away from it. We are not rushing to get in there. We have to let the smart money prove that they want to get in there and be buyers. And if they move the price away from it significantly, as we see here, okay, this is over 100 pips, which is a significant price swing. So when we have these intermediate term price moves like this, we'll allow price to come back down to where they bought before. Here's the down candle or bullish order block. When it comes back down there, they're most likely going to want to reposition more, okay, or put more allocation of funds to that same buying level, okay. And so when we start seeing more funding to that long entry, that's the idea at which we will be buying. Okay, we're buying with the anticipation of this being a sensitive price point, and they should buy more of it then because it's coming back to that price point. See how it just drifts lower, drift, versus a stark drop like this. Okay, this is just an absence of their willingness to be a buyer, and then price just drifts down. They buy a little bit in here, averaging in more, this down candle, which is another bullish order block, and that's why you see this little bit of a bounce in here, and then it drops down back to the average price where they want to be getting in at. Okay, so they buy a little bit more here, and then boom, see the difference or contrast from what you see here that would be viewed at an order block here. There's a little bit of bounce in here, but you got to go back to the point of origin where the original key level in the higher time frame takes place. When it comes back down to that level here, this is where we would be looking to be buyers. Okay, and we would be buying with the spread added to this level, or the spread added to whatever this opening price is on the down candle. And I've already shown you that we like to add 5 pips just to make sure that we have every opportunity to get in and not miss the opportunity of entry. And our idea is to have generally a 30 pip stop on average. Now, some of our viewers in the ICT camp are not able to be in front of the charts trading intraday precision, so they have to have a little bit wider stops. This is the benefit of trading swing trading style. Okay, you can use a 100 pip stop. Now I know you're probably saying, whoa, 100 pips, it's big. No, it's not. It's all relative to what you frame your risk around. Okay, there is no difference between me taking a trade framing 2% risk on a 30 pip stop than someone taking 2% risk and framing it on a 100% stop. Absolutely nothing. There's no difference in that. You're still only risking the same percentage of your account. The framework on the trade that you're trading may demand you to trade with a larger stop. There's absolutely nothing wrong with that if you are trading properly with a higher time frame or institutional order flow, as we're discussing here. So if we're trying to be a buyer down here, okay, we could be a buyer here, okay, and let's assume for a moment that we want to have a trade framed with buying here on a limit, and we're going to have the understanding that we can't be day traders. We can't be in there watching trades. We have lives at our office. We have children to take care of. Something that whatever it is, and it's too many variables to list here, but you get my point. Some of us are not into stages where we can be in front of the charts. So how can we participate in the marketplace and not be sitting in front of our charts? Well, this level here, you would know that once the price starts to run away, you knew it up here. So now you can say, okay, well, if it gets back down to here, I want to have a limit order and just let it sit there in the marketplace. And it goes a couple days before it comes back down and hits it. Bang, it fills it right there. You're not worrying about kill zones. You're not worrying about specifically being up at London or being up at New York open. You're just letting the market have its limit order resting in place. Okay, and because we're trading on higher time frame levels, we already know that the influence is going to be great in terms of magnitude if it gets to these levels again. In other words, this retracement, when it gets down here, there should be a large magnitude of influence or pressure on the buying side. And you see that obviously in hindsight here, but nonetheless, it's true to form to what we teach. So let's assume for a moment that you wanted to be in buying, okay, at what's the opening price on this candle? 93.88. So we're going to say 93.92. Okay, so 93.92, that would be our limit order. Okay, so you could fancy dance it around it to around number 90. Okay, so 93.90 would be our expected entry. Okay, and if we were going to use a 100 pip stop, for those that are not willing to be day traders and they have lives, they maybe have businesses, they just can't be in front of the charts. 100 pip stop down here. I think I just added one here. I added one more than I needed to. Okay, so our stop would be resting down here for a non-day trader approach to swing trading. Okay, so now here's where we have to factor in objectives. Okay, we already predefined our risk here, and we're going to say that this 100 pip stops is risking whatever, and we're going to use a standard 2%. 2% risk on equity. Okay, so this entry point here, the top of the green candle, and risking as much as this price point here. Now, because we have this price swing down and we are expecting bullishness, okay, there's several swing projections that you can utilize. And what I like to do is I like to take the fib and I like to use the initial retracement first, which is this little short-term high here. I anchor it from the high and I pull it down to the low at which it starts its move and where we're trying to get in at, in other words. You could take some of the trade off here at this old high once it trades to that price point, okay? And then you look for 200% extension, or basically the range from the high that it retraced from to your entry point, and that's up here, okay, right there. So you could take some off there as well. Or if you're in there for the long haul, what you do is you go back to the swing that set up the low that the whole framework it's hinged on. And it's this low here, market structure broke here and then retraced. Okay, so it's this low and the high prior to it that made a significant price swing, which is this high here. Okay, you see that? See, this is one price leg down. Okay, it's the second leg of the overall move that's from this high here. So we have a price leg from this high down to this low, and then we have another one from this high down to this low. Okay, but what I'm showing you is I use several approaches to pulling swings to measure upside objectives on longs, and it's a reverse for going short. But if we're buying down here, you use the initial retracement first to get your minor objectives. Then you go back to the swing that set up the overall parent price swing. And what's a parent price swing? This one right here. This swing up. Okay, you see that? Even though it's been long and drawn out here, this is the overall price swing. Okay, so this is where we pull it down to, and we look for extensions. This is where we would expect to take some profits at as well. Okay, and 200 extension is up here. Okay, so we have 200 extension up there. So if you're buying down here, okay, you have a little bit more than 3-to-1 risk reward. I'm sorry, reward to risk. 3 reward to 1 risk. And what we're saying here is what we have identified is we're allowing a 100 pip stop because we don't want to be in front of the charts. Okay, we can't become in front of our charts. We have other responsibilities that keep us from doing it. We would buy here and we would then watch price at our leisure when we can do it. Okay, and then what we do is we like to look for this stop as price starts to move away. You would reduce the stop to 80 pips risk, and as price starts to move out and take this high out here, right there, you would remove some more of your risk, take it down to 50 pips. Okay, and as price starts to run up and takes this high out, you want to take out all of the risk. So now you're in at your entry point with open profits, with no potential, virtually no potential to take a loss. Obviously, if the market got down some craziness like we saw in the Swiss earlier in 2015, the opportunity would not be you know, helpful to you for a stop loss because it's just going to gap through it, and that's the risk we all assume, and we understand those risks going into the marketplace. But looking at where we're at here, upside objectives for 200 extension, okay, or a symmetrical price swing. Okay, this is symmetrical. In other words, we have a perfect down move here. If we break this high, perfect symmetrical market structure should suggest that we should move up at least to that 200 extension. Okay, now you can use your 127 extensions and 162 extensions if you want to use those types of things, but I like using the 200 because it's a measured move principle. Okay, as price moves higher, okay, we're not in a hurry or a race to move our stop into profitability. That's not what you do in swing trading. You want to allow some room for the market to move. Okay, once we take out significant price highs, okay, then and only then can you start considering where we're at in terms of price to start moving in, because we could still come back down here, especially this low here. Price could come down there, clean that out, and then take you out of the trade prematurely, and that's what you don't want that to happen. And that's the reason why I like to see individuals take something out at predetermined levels. For instance, you had this high here. When price trades to it here, you could take a little bit off. Not a lot, just take something off of it. By doing that, in itself, it's also reducing your exposure to the marketplace. Your 2% risk is no longer 2% because you've taken something out. You've paid yourself. When price comes back to this high here, right there, if you take a little bit off there, it reduces your overall risk as well and pays you. If price comes up to the 200 extension, ultimately you've met your goal. Now, you're going to argue, I know, and say, well, if I've risked 2% down here, I'm not really getting 3-to-1. You're right. But I'm talking about you as a developing trader. If you can't be in the market real time, this is how you start. You graduate to that. Okay, you learn trading, you learn price action, you learn the concepts, and graduate to the point at which you can afford, number one, because you'll have the equity to be able to do it, and you'll have the understanding to couple with that equity to assume more real-time risk and not be so passive in your trading as we're describing here for swing trading. Okay, so that's how we would frame the idea, with a very small stop outside the scope of being a real-time day trader. You don't need to be a real-time day trader. You don't need to be in the marketplace, every 5 minutes. You can look at the higher time frames and frame out ideas and still get very handsome risk to reward setups. You don't have to take those levels out. You can, if you have strong convictions that you're right in your analysis, you can hold on to these objectives like we're suggesting up here. Okay, that would also bolster your effectiveness as it relates to patience and just sticking to your plan. So that's how we would use it. Now let's use the idea that this bullishness here, okay, how would we use that with going short in, say, the euro? Okay, well, we'll go over to our euro charts. Okay, and same way we see here, we start with our higher time frame weekly, and we go to our key support resistance levels, just the major highs and lows. Okay, the high of this candle, and I'll explain why I'm picking these in a moment, but we have the low, we have this low here, significant turning point. Okay, and that's primarily it. You don't have any other levels of any importance where we're at right now. We're inside of the consolidation, and those that have been following me know that I suggested that we could be in a larger trading range for a while, and we since already started that. Go down to a daily chart, same thing. Pull up our major highs and lows. Okay, we have a high here. We have a short-term low right there. And we'll use this one here because it was a reaction point. Okay, and below the market, we'll also just make sure we have this one as well. And that's it. We go back down, we minimize, okay? And now what we've done is we've identified support and resistance levels. We have not identified order blocks, okay? That's something entirely different. We're in a larger range like this. So what we're saying is the likelihood that we're going to be inside this range from 1464 to 108.17. In this range here, okay, we're trading between 114.35, noted as the high here, and we dipped below the 1148 level, so we want to say basically 110.50. So we're in a range between 114.35 and 110.50. So those are the two levels, or 1150, 1150 and 1050 and 1435. So those are the levels that we could take and transpose over to our 1 hour chart. $114.35, which is the high here. $11.50. I know it says 11.49 on the daily chart, but we're just going to round it to the near number, a round number rather. And then 10.50 below us. Okay, and that's what we have here. Now, going forward, using the hourly chart, that's when we go back down into using trend line segments, okay, to facilitate support and resistance, and keeping the delineation between higher time frame levels. Okay, so we have a low here that we went through. Okay, so we have a potential short-term resistance level should we bounce up there, much in the same way we saw this level here act like resistance. I'm not going to draw that here to keep it clean in here, but what we're saying is we were bullish on the dollar. Okay, so we would expect the range to be maintained here. Okay, we most likely won't see this high be violated. So the high that's formed in here, you see that forming here. Okay, that now becomes an area we would say, okay, this is the old high, which is this here. When price comes down, okay, we came back up into that range. Where is the order block here? We'll use the low up to the opening price of the up candle prior to the down move. didn't highlight the chart first. The low on this candle comes in at 113.23, 113.23, and the opening is 114.02. So we have to have, for trading, 114.02, which is essentially what, guys? 114 big figure. Right there. Okay, and then what we'll do is we highlight this with a color scheme that whatever one you like. I'm not going to try to force any particular color scheme on anyone, but this is where I identify on the daily time frame where the order block would be up here, and then we know that we don't want that. We would see the low at 113.23, right there. So in this region here is where we'd expect to see selling pressure. Okay, and some of you know that I went long last week down in here, or actually in here, and rode this thing up to take out this high. The reason why I did that is based on what we're showing over here and up here, and based on what we show on the dollar index as well. If we were bullish on the dollar, we would expect to see in this area, okay, selling pressure, not just in the middle, okay, but at logical levels. We saw this big drop down, okay, and the fact that there was a bullishness in the euro pound suggested that the euro would be stronger at the time and the pound would be weaker. Okay, so if you want to understand more about what I'm talking about here, there's a video on June 22nd describing all of those ideas as it relates to the British pound and the fiber and euro pound and the dollar. So looking at the idea that we would run the stops above here, okay, this rally up at the area at which we would see the order block, okay, which is the opening price on this candle here. Once it runs up, takes out those stops, this is where you'd be a seller. Now here's where you would look to be a swing trader, okay. We'll take this level off just for clarity, and this level off for clarity. Okay, we'll use this reference point in a moment, but for now, assume we were looking to be a seller up in here in this order block. This is the rally up that you would expect to see, and the 200 extension is down here. So this is where you would expect to take your profits on a swing trade mentality. Okay, right up in here. You want to get short. What are you getting short at? At 114 big figure. Okay, 114 big figure. And again, we can't be in front of our charts. We can't be real-time day traders. We can't be glued to the charts. You just place your limit order to sell at 114. Okay, and again, same thing. We use 100 pip stop. Okay, so we're going short in here at 114. $100 pip stop here. Our risk reward framework here. Okay, this would be 3 to 1. You don't need 3 to 1, but if you're looking for that, that's certainly how it would look. Then you have this price swing that started the whole thing. So it's up to this high here. Using this reference point, this high up to this low up to the high, because this is the parent price swing that starts all this move here. The 200 extension is down here, so this is a little bit better than 4 to 1. Okay, using a 100 pip stop, 4 to 1. If this is 2% risk here, you're potentially risking 2% to make as much as 8%. Okay, and that's not bad, especially for not being a day trader, especially for not being glued to the charts. Okay. Okay, so looking at where we're at in terms of identifying this area of being a seller. Okay, we identified this order block here on the daily chart. We understand how our ranges are going to be used. If we take this low out here, we would expect to see the next level here be taken out, and we would just basically watch as price starts to take out those levels. That's what we're looking for. We're looking for support levels to give way, and as long as that continues to happen, we maintain the trade. Okay, and that's the premise. That's the premise behind swing trading. But how can we, if we want to use a little bit more of our tools, especially as it relates to smart money, okay, and determining smart money principles, how can we identify this area and have confirmation that we do in fact see selling pressure coming on their way? Well, if you go and you add, we're going to add the dollar index for S&T principles. Okay, and we don't want the candles to show, and we want to make sure we show the moving average. Okay, and we put a little contrast in color, put a red on there. We'll weight the moving average a little bit thicker than 1, and because we're looking at the rallying up in the euro and we're anticipating a sell, what we're going to be comparing is the lows in the dollar index. So we're going to be contrasting the low. Okay, and we don't want to have any color on the grid because that'll be making a mess on our chart. Okay, so this is what we have. Here's the dollar index. So as price rallies higher here at a level of when we would anticipate some selling pressure based on what we've described over here. Okay, look what happened. We made higher highs in the euro, but were we making lower lows in the dollar index? Absolutely not. Absolutely not. That's SMT divergence. That's the Kraken correlation, or the evidence that they're buying dollars there. Even though that the euro went higher, okay, at a level we would anticipate resistance, it's qualified and confirmed when there is a failed lower low in the dollar. That means that they're buying dollars exactly where you would anticipate resistance forming in the euro. Okay, well, wouldn't you know it, the same thing's happening as well when we trade back up to this level here. We're going to look at this high here and this high here. So basically the high between these two purple levels. Okay, did we make a lower low in the dollar index when when the fiber went back up there and ran this high? Absolutely not. So we went higher here, but we did not see a lower low in the dollar, which means what? They're accumulating more long positions in the dollar. Because our analysis really hinges on the strength or weakness of the dollar, that's the basis of why we begin there, because it gives you every ability to see what the smart money is doing on a grand scale of what it is, on a grand scale of what it is that they're doing, being a buyer or seller. So we have this divergence between the two. Now, again, it's comparing price action only. I'm not giving you momentum indicators for divergence. I'm showing you divergence as it relates to price action. Okay, so when we see this, this is exactly what you would anticipate happening. See, this should have been a lower low here, and it didn't happen. This should have been a lower low here, and it didn't happen. And look at the extrapolated move up in the dollar. And look what happened with the euro. It fell out of bed. Okay, you see that? So now, when we look at charts like this, we are not reacting. We're not chasing price. We're waiting for price to provide the understanding of what it should be doing based on higher time frame principles and moving that into a executable time frame. Now, we can go down into smaller time frames, 15-minute, 5-minute, and even reduce the risk for those that want to have these same principles with smaller risk, the individuals that have the opportunity to be in front of their charts a little bit more, and you would just simply go down to a lower time frame and then look for order blocks, bearish order blocks, and levels to do turtle soup short positions in here as well. Some of you know, and you watched the trade I put on, I went long down in here and I exited at 114.07. The actual high was 114.10. That's the reason why, based on everything we're showing here, that was the premise why I didn't want to hold on to the trade longer than that and why I exited there. Okay. So with this in mind, if we have this understanding, um, we can arrive at pretty handsome risk to reward ratios if we can go down to a tighter time frame. In other words, if we have the ability to go down to a lower time frame and use these ideas, we can use day trading entry styles to get in on these setups. Now, let's assume for a moment that we use our standard 30 pip stop loss, and we want to get short in here at that 114 level. We have a 30 pip stop right here, so we would be selling in here with a 30 pip stop. If we're looking for setups that pay based on the swing projections only, not framing them just on more dollar risk. Okay, if we're looking at the swing or market structure components, this low up to the high. Okay, the swing projection suggests 200% of the price leg is replicated from this high, this low up to the high. Okay, if price breaks this low, we'd expect to see it trade down to 200%. If that happens, okay, what we're showing you is for those individuals that do have, and I'm not trying to make the individuals that can't be in front of the charts feel bad or feel like they are just missing out. It's just, this is unfortunately one of the things that you can't do yet, and that's fine. There's nothing wrong with that. Right now you just don't have the time or the resources to make your trading more closer to real time or day trading ideas. But the individuals that do, 200 levels down here, so just a little bit. So we'll take this out. We won't even use this one. Okay, so you have 1, 2, 3, 4, 5, 6, 7. 7 to 1 reward to risk. Okay, and that's a swing trader's mentality or swing trader's model based on what we've shown here. Okay, and obviously when you go back through your charts and you see examples like this, they happen a lot. Not a lot like day trades, obviously, but they happen a lot throughout a quarter. In other words, every 3 months you get a handful of them, and if you just are patient enough to sit around and wait for those opportunities like that, you don't need a whole lot of trades if you're getting 7 to 1 reward to risk. Okay, now think about it. If you are risking 2% here, you're making as much if you hold a position with no scaling out. Your risk is 2%. Your payout, okay, is what? 14%. Sometimes that's better than most people do all year long with all of their trading, and sometimes a lot of trades to do it too. So imagine if you just do this once every 2 months. Just once every 2 months, if you can get a pair that will pay you something like this, okay, every 2 months, how much money could you potentially be earning? It's a lot. And imagine by doing that 2%, every time your equity increases, that 2% is a lot more each new trade as your equity builds up. And you don't need to trade a lot. That's what I've been talking about ever since I began teaching as a mentor. The greatest lesson I learned was not to be so busy in the marketplace. I did not make more money when I was more active. I didn't. Actually, I lost a lot more. And I lost peace of mind. I felt like I was doing too much, and I was. And I never enjoyed what I was doing. I was always getting that emotional fix, and that's not what you want to be doing in trading. Okay, if it feels like that, you're gambling, and I admit it now, and I admit it in other places. There were times where I was just gambling, just because I needed to feel that engagement of the marketplace, and I lost track of what I was doing, and which is running a business. Okay, so understanding where we're at on the higher time frames, okay, is paramount. And looking at where we're at in terms of what the dollar's doing is absolutely crucial. When we are on the higher time frames, okay, we expect selling pressure up here at 114.35, which is up in here because the dollar was bullish. We expect this high to stay in place. If it gave way a little bit, we would know that it's possibly going to be what? A turtle soup. It's going to be a false break. So if it comes up there and then say you shorted here and it blew you out, as long as the dollar still posted bullishness, you know that the setup is eventually going to come away, and you would see this later phenomenon take place where another rally up, then you would sell into that. So it's not that you should be fearful of taking a loss. You just have to have the convictions to stay with the trading idea and not flip-flop back and forth. Well, if I get stopped out here, I'm going to be a buyer then, and I was wrong. Don't think like that, because if you're looking at the higher time frames like this, they don't change gears very often. They stay in sync or momentum for a long period of time. For a perfect example, I mean, when we moved from this high up here, it moved a long period of time. The majority of May, it was down in the euro. Okay, and then we saw a nice rally up, and look how much time we spent making bullish moves higher. Okay, so I could teach on and on and on about every specific aspect of the swing trading idea or method, but this particular template or model, okay, or module rather, is really just meant to use the higher level key support resistance levels, and then once you get in sync with a move, what you're looking for is the counter levels at which price should reach for. So when it started selling off here, we know that price is most likely going to reach to this next level, and if this level is taken out, the next level will be reaching for this level. If this level gives way, it's going to reach down to this level, okay? But before this level is touched, that's where we incorporate the order block, because there's no bullish order block. Once we get this low taken out, there's no other order block, and it's a liquidity void right in here. So price should come down, come into this area here. We might get a little bit of a bounce, come back up to this level, and create another opportunity to sell off, okay, and then trade lower. And that's assuming we have continued movement lower in the euro and bullishness in the dollar. If the dollar gives way and softens up, we could come down to this level here and create a bounce, and that's fine, because then if we see a bounce at 1050, which is lower over here, if we get a bounce down here in the 1050 level down here, okay, notice on this chart you don't see anything that would indicate there's a reason to expect that, but based on what we have over here, there is. You see? So that's the benefit of having a higher time frame understanding, that way you can frame your swing trades. And even if you're not a swing trader, you can use those same setups to be a day trader or short-term trader, as we'll discuss when we get into those modules. But you have to understand what these higher time frame charts are reaching for. When they're reaching for these levels, okay, if they fail to get to that level and they show a willingness to bounce at a specific level that you've already identified, there's no reason to rush. Absolutely no reason to rush, because if it's going to go higher, it'll retrace and give you an order block like we disclosed in the understanding with the dollar index at the beginning of the video. Okay, so what are we saying here for swing trading? The idea is you go through the higher time frames, look for key support resistance levels, highs and lows, because that's going to show you where the intermediate term price swings have made its move. Okay, and we understand that the big deep pocket traders move the markets on these higher time frames, not small retail traders, not little small fries like you and me. The big guys, the large institutions, have the money to move price on these higher time frames, and when they do, it stays in motion for a longer time. So if we arrive at these levels, we can take trades with a longer term perspective in mind and hold on to them a little bit longer than just intraday day trading. Okay, so hopefully this has been insightful to you guys, and we'll build on this idea as we move into the shorter time frame trades, like short-term trades, and then obviously we'll talk more about this as well when we get into the day trading. So with that, guys, I wish you good luck and good trading.